Hi, my name is Jennifer, and I want to help you live your best life. What are stocks? What's a bond? And what on earth are index funds? Stay with me, and you'll find out. Let's go. Let's say there is a business. We'll make it an ice cream shop. And the owner of this business wants to raise some money to grow this business. So, she'll divide her company into small pieces and sell these pieces to the public. These pieces are called shares or stocks. Now, let's say you come along and want to buy one of these pieces. When you do, that makes you a part owner. Exciting, isn't it? That's like if you buy a share of Coca-Cola, you can tell anyone who's drinking a Coke that you own a teeny tiny piece of that. Sort of something along those lines. But this is our number one thing to remember. When you're buying a stock, you're buying a piece of that company. So, back to our ice cream shop. When the owner decides to sell pieces of her company, she goes to list these shares on the stock exchange. The first time they're ever traded on the exchange, in other words, when the company goes public, this process of selling the shares is called an IPO, an initial public offering. It's self-explanatory. It's the first time the shares are offered to the public. So, through this process, private investors sell their shares to public investors. Another advantage of going public is increasing the company's public awareness because IPOs usually generate publicity. Also, some founding individuals use IPOs as an exit strategy to sell their stake. Good so far? Okay. Now, during an IPO, an investment bank uses valuation techniques to figure out the company's value. So, let's say the ice cream shop's value is $100,000, and if the company is divided into 10,000 pieces, each piece will be $10. So, the shares will be issued at $10 per share. Now, let's say you bought a share of the ice cream shop during its IPO. Now, you own one share of this business and paid $10 to buy it. From this point, you can sell your share to anyone else on the stock exchange. Once this trading starts, the share prices will change. Now, share prices usually change based on supply and demand, market news, or herd instinct. If our ice cream shop is showing a positive outlook, more people will want to buy it, and hence the share price will be higher. And the opposite is true. If more people want to sell, then the share price will go down. Other factors like earnings reports, political events, company events, and economic news also affect the share's market price. And the third phenomena that drives share price is the herd instinct. This is when people just mimic a large group of people and what they're doing. So, if more and more people are buying a certain stock, then the price will drive higher, leading more people to buy because they're scared of missing out. This is something you don't want to do. You do not want to buy when everyone is buying. So, how do you make money from stocks? There are two ways. The first way is when the stock appreciates in value. Let's say you own one share of the ice cream shop and didn't sell it for 10 years. That one share that cost $10 when you bought it now costs $15. So if you were to sell it, you would have made $5. So how do you know which stocks will grow in value? The ones that stand a good chance are solid, well-managed companies that turn a profit. The second way to make money from stocks is via dividends. What are dividends? Some companies pay their shareholders regularly as a thank you for owning their shares. So if you own stocks that pay dividends, you have an income stream right there. Given, if you want to grow your money as fast as possible, it's better to reinvest those dividends than spend them as soon as you receive them. Some brokers or companies offer a DRIP program, which stands for a Dividend Reinvestment Plan. This is when your dividends are automatically reinvested. So instead of taking the cash out, you automatically buy additional shares. Alright, so we've covered the basics of stocks. Now let's move over to bonds. Simply put, a bond is a loan, a fancy IOU. When you buy a bond, you're loaning money to companies or governments for a certain period of time. In return, you get interest on the loan, plus the entire amount paid back on a specific date called the maturity date. The length of time to maturity is called the bond's term, and the interest payment is called a coupon. So, if a $1,000 bond has a 7% yearly interest rate, it has a $70 coupon. Now, bonds are rated by how high the risk of default is. High-quality bonds are called investment grade, and low-quality ones are called junk bonds. Usually, the ones with a poor credit rating pay more interest because the issuer is less stable. Also, bonds that have a very long maturity date also usually pay a higher interest rate. Why? This is because the longer the time, the more exposure the bond will have to interest rate changes. Why does that matter? Because if interest rates go up, bond values go down, and vice versa. Now, what if you say, I don't know what stocks to pick, or I don't know what bonds to pick, or I just want to be a passive investor? That brings us into the world of ETFs. An ETF stands for Exchange Traded Fund, and it is a basket of different securities. It can be a basket of stocks, a basket of different types of bonds, or even currencies or commodities. ETFs are super good for diversification. For example, let's take an ETF that tracks the S&P 500 index, which is made up of the 500 largest US publicly traded companies. If you buy one share of this ETF, it's like you bought a small piece of every company in the S&P 500 index. You can even buy ETFs that track certain industries or sectors. Just make sure to always check what the expense ratio of the ETF is and if there are any other fees associated with the one you pick. Remember, you always want to keep your fees down. So to recap, look at a share like a mini business. A bond is basically a loan to corporations and governments, and ETFs help you diversify while maintaining low fees and trading costs. If you enjoyed this video, please hit the like button, and if you'd like to see more, subscribe to the channel. Thank you for watching and have a great day.